If you're using Charles Schwab as your broker and you're sitting on uninvested cash in your retirement accounts or your non-retirement accounts, you could be missing out on an opportunity to earn up to 10 times more on that cash by following a few simple steps. In this video, I'll talk to you about how you can take that cash and put it in other places at Charles Schwab and significantly increase the return on that money. So with Charles Schwab, like many other firms out there, when you put money into your account, that could be either through deposits that you're making, through selling other investments, or through dividends that hit your account that are uninvested. Your money is automatically getting put into the Schwab Bank Investor Savings Program, which currently is paying 0.48%. So that is well below what many other money market funds are paying. But Schwab does offer other options, but you have to take the necessary steps to actually move your money from the bank investor savings money market to one of the others. So the first place you'll want to go is schwab.com/cash-investments. So that's where I am right now. So clearly you can see on this page that there are other options to earn higher yields than the Schwab default money market. So we have other money market funds and also certificates of deposit. If you're willing to invest your money for longer term, you might want to consider using the certificates of deposit. There are a number of CDs issued by banks that Charles Schwab deals with. These are called broker sold CDs. So what this means is you don't have to actually open up another account at that bank within the same account, whether that be your retirement account or a taxable investment account. You can buy CDs. But in this video, I want to focus on the more liquid option, and that being the Schwab money market funds. So if we click here on Schwab money market funds, so first understanding what a money market fund is. A money market fund is a mutual fund that invests in short-term, high-quality securities. Sometimes these are treasury bonds. Sometimes these are known as commercial paper, which means there are short-term loans that are being made to high-quality corporations, very short-term, like 30, 60, 90 days, sometimes to banks as well. So because of that short-term nature, these are regarded as being relatively safe because those companies, financial institutions, have to pay that money back in a short period of time. Now, most money market funds trade for $1 a share. So unlike other mutual funds that will change their share price on a daily basis, money market funds' goal is to never break the dollar. Now, money market funds have been around for a long time, and as far as I'm aware, there's only been, I think, 1 or 2 funds that have ever broken the dollar value, and that occurred during the 2008 financial crisis, the global financial crisis. So it's a relatively safe investment. There's very low probability that you would ever lose money in the fund. And how you would lose money in the fund would be that the fund broke the dollar. So how you make money in the fund is by the interest that the fund pays. So these are some of the money market funds that Schwab offers. We'll start at the top here. We have their prime funds, and these are the ones that are paying usually the highest interest. So the easiest one that most people can invest in would be the Schwab Value Advantage Money Fund, SWVXX. We can see from here that this fund has a 7-day yield of 5.14%. And there's currently not a minimal investment, meaning if you had $1 that you wanted to put in this fund, you could put it into this money market fund. Whereas they have another one that pays even more, that pays 5.29%, the Schwab Value Advantage Fund, but that has $1 million initial investment. So you'd have to be able to invest $1 million into this fund in the same account, I believe, for you to get over the hurdle to buy this fund. But that's okay. We can focus on SWVXX. So with money market funds, their interest they pay can reset every 7 days. And what that means is if there was a change in interest rates, if interest rates were to go up, let's say, then there most likely would be an increase in the interest that this fund is paying. Because these investments in the fund are relatively short term, we're talking again about 30, 60, 90-day investments, those investments would mature, and then whoever that money was being lent to would borrow the money again, but the interest that they would pay would be lower because it's usually tied to some short-term interest rate like the federal funds rate or another short-term interest rate. So if rates were to go down, if interest rates were to go down, if the Federal Reserve were to start cutting rates, which they're talking about doing in the near future, then the interest you're getting on this fund would go down. So I was talking earlier about CDs versus money market funds. If you were investing this money for longer term, let's say you weren't going to touch this money for 2 years, you might be better off buying a short-term CD because you'd be able to lock in your interest rate for that 2-year period. If in the next 2 years, interest rates go down a lot, then you would have been better off most likely locking in into a short-term CD, a short-term treasury bond, rather than being in money market because the fund interest could go down. However, if you want this money to be liquid, if you want to be able to access it at any time, then a money market fund could be a better choice for you. So that interest it's paying is only part of the story. That 5.14% would be the annual rate that you would receive if you didn't sell this fund over the next year, and if nothing changed in the fund. If interest rates weren't changed at all, then that's the interest that you would earn over the next year. These funds pay their interest monthly. So let me just click on the fund just to show you a couple other things while we're here. The other thing to know is that all money market funds have some type of an annual fee that you have to pay when you own the funds. And that's called the net expense ratio. For this fund is 0.34%. So that's an annual fee. Let's just assume for the next year, nothing changed in that fund. It paid 5.14%. Then you need to reduce that yield by 0.34% to come up with what your net return would be, because you're going to be paying that net expense ratio. You don't actually see that fund, that expense being paid. It's taken out of the fund on a daily basis, but that is actually reducing your return. So you can see how much money's in the fund. There's currently $198 billion in the fund. So there's a lot of money in the fund. There's other information in here about the fund, but that's just a little bit of how that fund would work. Now, if we go back and we scroll down a little bit further, there are other money market funds that are available as well. We have other funds that focus more on government bonds. This is the SNVXX that just invests in government bonds. There are ones, if we go further down, that are municipal bond funds. So you can see the municipal bond funds pay lower interest than the other ones because of the fact that this is municipal bond interest. So why might you want to buy one of these funds? Well, if you're in a high tax bracket, or if you're in a state like California or New York that has high state income tax, by putting your money into one of these funds, you could potentially be earning more money than by going into one of these other ones, because these other funds are taxable. So if we're talking about non-retirement money and you put money into these money market funds, realize that at the end of the year, you're going to receive a 1099 and you're going to have to pay tax on that interest if it's taxable. If it was a municipal bond fund, then you wouldn't have to pay state income tax on it if it was in California and that was your home state, and you also wouldn't pay federal tax on it. So they have a number of different options that you could buy within here. So that's the good news, that Schwab has a lot of options. The bad news is that to be able to get into these funds, you have to take the next step. So that's what a lot of people fail to do. So the next step is that you actually have to purchase these funds. As I said before, money that hits your account, deposits, sales of securities, dividends, interest, if that's just automatically going to the Schwab bank deposit fund that's paying 0.48%, you actually have to go into your account and you have to purchase one of these other funds. You have to go into the trading option in your account, or if you work with an advisor, have your advisor go in and purchase the money market fund. It's not a big deal, but it is an extra step. Once you do that, let's say you had $10,000 that was in the default money market fund and you want to purchase SWVXX, you go in, you put in the order for SWVXX, and now the money's been moved over into the higher yielding money market fund. So that extra step is important that you take, because if you don't do that, the money is just going to sit there in that default money market fund. Unfortunately, that's part of the thing that Schwab is hoping, because that's part of the way Schwab makes money. That's how Schwab is able to offer a lot of things for free to investors, because a lot of people don't know about this. They automatically go into the default money market fund. Their money's sitting there, not earning as much interest as it can. So make sure that you take that extra step. And then if you want to use the money, let's say then you want to use the money to buy another stock, you need to sell the money market fund first before you could buy the other stock. So this would be the case for retirement and non-retirement accounts. The nice thing is that if it is a retirement account, you're not going to ever pay tax on this interest as you're earning it in the retirement account. When you take the money out, it could be potentially taxable, whether it was a traditional IRA or 401k. If it was a Roth, it wouldn't be. But in the meantime, any interest you get on the money when it's in that retirement account, that is going to be tax deferred and not paid. So in that case, if we're talking retirement accounts, you'd probably want to go with one of these the two highest yielding money market funds. For taxable accounts, you'd want to figure out whether you should just go into the highest yielding or maybe the treasury, one of the treasury options, or one of the municipal options. Check out your Schwab account, see if you're sitting on money that's in the default money market fund. And if it is this bank deposit program, look at one of these other options, whether it be buying a short-term CD or moving it into the money market. If you like this video, please click the subscribe button below. And thanks for watching. Take care.